inventory. Okay, so we're looking at cost flow assumptions, mainly cost flow assumptions, and then when do we recognize the inventory in our balance sheet and income statement. Before I get started, I just wanted to mention that I sent an email regarding Tableau. I have some information to allow you to download the program. I think it's like a 1-year license. So I'm going to send further instructions for that sometime today or tomorrow. Okay, so just FYI on that. Any questions before we get started? We're all good? Okay. All right, so inventories. So inventories overview, just a general understanding of inventory. This inventory is for resale. We may be maybe buying it if we are a reseller from a wholesaler, or maybe we are manufacturing or producing this inventory. And then inventory, basically, once that we have title, it will remain on the balance sheet until it is sold, at which time it will be transferred into the income statement in the form as cost of goods sold. So we have two different groups, I guess if you can call it. We have a reseller, like we said. They purchase from wholesalers and sell it to customers, or it could be a wholesaler selling to a retailer. And then we have a manufacturer, which means that they are actually producing, manufacturing this product. And so if they are manufacturers, we're going to see that there's going to have a different breakdown or presentation on the balance sheet. Okay, so just giving the specifications of, the raw materials, work in process, and finished goods. And I'm sure you guys are having or will have a lot of fun next semester when you sign up for 305. So you're guys are gonna be looking at this in more detailed. All right, so we have a real life example here from an annual report. I want to say this is from Nike. I'm not sure. Oh, no, I'm sorry. Here, Intel Corporation. Okay, and then we have the T accounts of the flow of these raw materials, direct labor, and manufacturing overhead, if you recall this from your BA 201, and how this flows into work in process. And once the product is completed, then it goes to finished goods. And once it's sold, then it's transferred to cost of goods sold. So we have basically two types of inventory systems. We have the perpetual inventory system, and then we have a periodic inventory system. So we're going to try to cover both of them. The perpetual inventory system is probably the one that's most widely used at this point, given the availability of technology. So this is the one that keeps track of inventory continuously, so that we know our level of inventory at any time. Okay, so we can access the computer system. We can look at our inventory system, whether we need to reorder that or not. So it's like on time, right? Versus, okay, so we have an example of the perpetual inventory system. We have Lothridge Wholesale Beverage Company purchases soft drinks, and then they sell them to retailers. The company begins 2021 inventory with 120,000 on hand. They purchase additional 600,000. They sold 820,000. And then their ending balance in their inventory, the cost of soft drink inventory sold is 540,000. Okay, so they're basically giving us their cost of goods sold. Lothridge uses the perpetual inventory system. The system indicates that the cost of inventory on hand at the end of the year is 180,000. So we have the journal entries, and I think there's another slide where it shows each of the inventory systems side by side so that you can see the differences in terms of journal entries. But this is the perpetual, so we're gonna use inventory, and we're crediting accounts payable, or it could be cash. And then this is for the purchase of inventory. If we sell that inventory, then we're gonna have two journal entries. One to record the sale, and the second one is to adjust our inventory levels and then record the cost of that inventory that was sold. So just an obvious, but I just want to point out that, of course, the sales price of the inventory is going to be higher than its cost, right? Because that's how we make a profit. Okay, so this just talks about the technology that's associated with the perpetual inventory system. It could be, very sophisticated, whether you have maybe a retailer that has coordinated a system with a wholesaler. So when their inventories hit a certain amount, it will automatically reorder that inventory from the wholesaler, and they will make it available to the retailer right away. Okay, so different systems. The next one is the periodic inventory system. So this one is probably a little bit outdated. Most people have the perpetual inventory system. However, you may have some companies, I doubt it, but we still have to learn the periodic inventory system just in case, okay? And so in this regard, the drawback of the periodic inventory system is that we don't know what the ending inventory is for the period until we actually do a count. And that's when we are going to actually recognize our cost of goods sold. So cost of goods sold and ending inventory remain unknown until the end, when we're able to count our inventory. So cost of goods sold is more of a plug figure. So Lothridge Wholesale Beverage Company, we have the same information that we were given before. And so now we're going to show the journal entries under the periodic inventory system. In this case, instead of using inventory when we do the purchases, we're using purchases. Okay, we're using this account called purchases. And then when we sell the inventory, we are not going to record cost of goods sold because we need to wait until we're able to count our inventory, our ending inventory. So we're only recording the sale. And so once that, the period ends, then we're gonna figure it out. What is our cost of goods sold? Let's say we went to the warehouse, we did a physical count, so we know what our ending inventory is. So now we're ready to calculate our cost of goods sold. So cost of goods sold is going to be our beginning inventory plus purchases. This equals our cost of goods sold available for sale. And then we subtract our ending inventory to arrive at cost of goods sold. So now we're ready to do our final journal entry, okay, at the end of the year or at the end of the month. However, we're doing this calculation, we are going to debit our cost of goods sold, debit our ending inventory, get rid of our beginning inventory, and then credit purchases, okay. So inventory and purchases, they're gone, and now we have this inventory ending. Okay, so this is the periodic system. Okay, so you have some explanation here you guys can go over. some exercises that are included with the PowerPoint, which is available in Moodle. All right, so now when we talk about inventory, it gets a little bit more complicated because you have different arrangements of things that are happening. So sometimes, it's not clear whether we should include this merchandise in our inventory or not. So basically, we have to, of course, our inventory will be any items of inventory that we have in our possession, right? So we go to the warehouse, we count our inventory. That's physically, we have that, and therefore it's going to be reported on the balance sheet as inventory. However, there may be instances where the inventory is in transit, and so we have to determine who owns this inventory. Is it the seller or the buyer? At which point does the title transfer? Okay. Then we may have inventory that is on consignment. So we have to see who owns that inventory, who's going to report that inventory on the balance sheet. And then remember chapter 7, we looked at anticipating or estimating sales returns. So that is something that is also associated with our inventory levels. So goods in transit, we basically have, there may be more, varieties of this, but we have two: FOB, shipping point, and then FOB, destination. So if, we have, for example, here in December 2021, the Lothridge Wholesale Beverage Company sold goods to Jabbar Company. The goods were shipped from Lothridge on December 29, but the goods didn't arrive at Jabbar until January 3rd. Okay, so the following year. This is a calendar year company. So basically, if the goods were shipped FOB, shipping point, that means that from the time that it left Lothridge warehouse, the title has transferred to Jabbar. Okay, so in this case, Lothridge will have to credit the inventory on December 29th, and then Jabbar is going to debit the inventory purchase. Okay, so basically Jabbar is the one that's going to be reporting that inventory at the end of 2021. If it's FOB, destination, that means that the title doesn't transfer until it reaches Jabbar's warehouse, right? So in that case, while in transit, Lothridge still owns this inventory. So Lothridge will still include that inventory balance on their balance sheet, and they will actually not transfer until the following year, 2022. Okay, so you have an example here you may want to review. I think you have an assignment that's similar to this. We'll take a look at the assignment or the exercises next Tuesday. The goods could be on consignment. So that means that the transferor or the consignor is the one that owns the inventory. Okay, they are the ones carrying that inventory on the balance sheet. They're the ones reporting cost of goods sold on the income statement. But they have a sort of an agent, okay, an agent. So let's say you're trying to sell t-shirts, but you don't have a store, and so you just having your friends sell the t-shirts for you. Okay, let's say that he has a stand, I don't know, at the flea market or somewhere, and he's selling it for you. So he didn't actually buy this merchandise for resale. You're just gonna pay him a commission. You're gonna say, hey, for each t-shirt that you sell, I'll give you 10% of the sale. Okay, sales price. So in that case, the consignee, your friend, is an agent. He's working for you. All right, but you're still gonna carry that inventory in your balance sheet. and the cost of goods sold in your income statement. So when we're talking about consignment, you gotta be clear as to who's a consignor and who's a consignee, okay? Because the consignor is the one that's gonna keep track of that inventory and report the inventory on their financial statements. Now, sales returns, we took a look at that last chapter. So we, if you remember, we had that refund liability, right? And then we had a debit to sales returns, and then a credit to the refund liability, or a debit to sales returns and a credit to accounts receivable, okay? And then the second part was the decrease of cost of goods sold and the debit to inventory. So if you remember that from last chapter, this is what we're talking about here. Other things that might affect inventory, aside from sales returns, will be, for example, freights, costs that are related to inventory. So when you are transporting inventory, of course, you're going to have insurance, right? Because if something happens, let's say that we're having something shipped by sea, from California to Guam, it's a long trip, and therefore of course we want to get insurance, because if that ship sinks in the middle of the sea, we're gonna lose our inventory, right? And so if we're insured, hopefully we can recoup some of that cost. So it depends if we're using a periodic or perpetual inventory system as to how we're going to treat these expenses. If we're using a perpetual inventory system, any freight cost will be added to the cost of our inventory. So we're going to be debiting inventory and credit cash, let's say, for the freight cost, for the insurance, for any sales taxes that we were charged. If we're using a periodic system, then we're going to have an account called freight in or transportation in, okay? Because remember that under periodic system, we're using purchases instead of inventory. If we are shipping to our customers, then that's an expense. That's not included in our inventory. This is if we are the buyer. So this top part, you purchase inventory. Here, you are selling the inventory. So if you are selling the inventory, these expenses associated with transportation are expensed, as you can include that expense under cost of goods sold or as a separate item. See, a buyer views a purchase return as a reduction of purchases. So we're talking about purchases returns here. Again, it depends on whether you're using perpetual inventory system or periodic. If we're using a perpetual inventory system, we're just gonna credit the inventory. I'm sorry, we're going to we're going to reduce our cost of goods sold, and under the perpetual inventory system. Under the periodic system, we're actually going to have an account called purchase returns, and that's going to reduce the amount of our purchases. And maybe this is going to make more sense as we are doing the exercises. I think most of the exercises deal with perpetual inventory system, but you may have some periodic in there, but mostly related to cost flow assumptions, which we're going to go into that next. Here we're talking about the discounts. If you recall this from BA 200, we talked about when we purchase or sell merchandise, we might offer, or we may be offer, if we're actually buying discount to as an incentive to make sure that we pay early, right? So in this case, the 2 stands for the percentage of discount that we are being offered. And then the next number indicates the number of days that we need to be in compliance in order to get a discount. And if not, then we're just going to have to pay the full amount. So in dealing with discounts, now discounts, sales discounts are different from trade discounts, okay? Trade discounts is, for example, I said, okay, I'm a wholesaler. If you purchase 100 boxes of this drink, you get a 20% trade discount. If you purchase 10 boxes of this drink, you only get 5% discount. So that's a trade discount. So usually it's based in bulk, right? The bulk of items, the number of items that you're purchasing. If we have a trade discount, then we always use the net method for that. Okay, if we have a trade discount. If we have a sales discount, which is what we're looking at right now, we have 2 choices. We can use the gross method or the net method. Most of the time, companies will use the gross method because under the net method, if you don't take the discount, then it's gonna say discounts lost on the income statement, and management doesn't want that to be reported on the financial statements. Okay, so the gross method gives us a chance to kind of hide that if we're unable to pay within the discount days. So basically we have a 2%, so you can multiply the gross amount by 98% or 1 minus the 2%, and that will give you the net amount, right? The net amount. So if we're using perpetual system, we're going to debit inventory and credit accounts payable. Gross method, nothing. We ignore the discount. With the net method, is net of the discount. Okay, if we happen to pay it within the 10 days, if we're using the gross method, that discount, remember we're using perpetual inventory system, right? Oh, wait, let me get my pen. Perpetual inventory system, we're going to use inventory. We're going to credit the inventory account for the discount, okay? Credit the inventory, reduce the inventory to the amount that was actually paid for this inventory. And then we're gonna, if we have the net method, we are just gonna, debit accounts payable and credit cash because it's already net of the discount. And then if we default, okay, we don't take advantage of the discount. Maybe we are short of cash. We're unable to take advantage of that at this point. Under the gross method, we simply debit our accounts payable, credit cash. Okay, so here you can't really tell whether we took the discount or not, right? It's more hidden, but with the net method, you can really see because we have this purchase discounts lost, which is going to appear on the income statement. And so everyone will be able to see that we didn't take advantage of the discount. If you have any questions, just interrupt me or post it in the chat. All right. Okay. So inventory transactions using perpetual and periodic systems, and they give us a bunch of information. So you have side by side how the treatment of the different items would be under the periodic or perpetual system. Just want to bring your attention to, for example, the first one we already talked about on the purchase of inventory, that under periodic system we're using a purchases account. In terms of freight, when it comes to perpetual, we are adding that to the cost of our inventory by debiting inventory. But with the periodic system, we're using a freighting account. If we have any returns, we are using this purchase returns account. Now, when it comes to discounts, note here that we just said that we're gonna credit inventory for the amount of the discount if we take advantage of it. But look at under periodic, we're using purchase discounts account, okay? And then we said when we sell an item, we're gonna have two entries under the perpetual system. Under the periodic, we only have one. And then at the end of the period, that's when we actually report our cost of goods sold and ending inventory. Okay, so take a look at those differences in terms of journal entries. Okay, so now we start looking at inventory cost flow. So basically, let's say that if it were selling a bunch of t-shirts and all the t-shirts look the same, and so let's see here, we purchased 4,000 t-shirts at $5.50, 1,000 t-shirts for $6. Now, when a customer comes in and buys a t-shirt, they're all white t-shirts. They all look the same. Therefore, we don't know if the cost would be $7.50, if it will be $6, if it will be $5.50. It's impossible to tell, okay? And so we have different methods to kind of allocate the cost to the units that are sold and the units that remain in inventory. And excuse me, I'm sure you guys are familiar with these. If you remember BA 200, I know it's been a while. So we have here an example. We have our beginning inventory is 4,000. We add the purchases, and that's our goods available for sale. So the whole world of units is 11,000. And then at the end of the period, we have 4,500 remaining units in our inventory. And then we sold 6,500. So we have to find a cost for the units that are remaining in our inventory on the balance sheet and the units that were sold and will be reported on the income statement. Okay, so we need to find a cost for these. So in looking at the cost flow assumptions, we have basically four. One of those is the specific identification method. This is probably the easiest one to use because where the units come from, it will be pretty much told, right? They're going to say exactly, okay, if we're looking, for example, at this, let's say, they're going to say, oh, okay, we sold that t-shirt from the $6 stack. Okay, so specific identification, they will tell us exactly where it's coming from. Usually is used for items that are different. They're very special, and therefore we can track those items easily, maybe like luxury items. So in that case, we only sell a few, so we know exactly what layer of inventory is coming from. For everything else, we basically have three methods. One is the average cost, which, like the word said, it takes an average. Then we have first in, first out. And then we have last in, first out. So basically different assumptions. On first in, first out, we're saying, okay, the sale is coming from the older units that we have. Merchants always want to sell the first, the oldest inventory, because the longer that it stays in their warehouse or whatever they're keeping that inventory, the likelihood that it will be damaged, it will be outdated, obsolete, etc. Last in, first out is saying we're gonna be selling the latest purchases. Maybe it's like a fashion industry, so you can see that will make more sense. Okay, so for the average cost, the basic formula is that we take our beginning inventory, our purchases, we have all the goods that are available for sale, and then we divide that by the number of units that we have. And so we come up with an average, okay? So it could be as easy as this. So if we're using periodic, okay, this is the calculation that we will do because we are already waiting till the end of the period to do those calculations. It gets a little bit more complicated when we're using perpetual inventory system. So with the perpetual inventory system, we have to calculate the average cost per unit once we have, a purchase. At every purchase, we should calculate an average, and we're going to use that average to, for the sale and the units that remain in inventory. So for example, here we start with our purchase, 4,000 units at $5.50. So we know that right now our average is to $5.50. We have a sale on the 10th. So the first thing that you need to do if you have a problem is probably set it up in chronological order. Okay, because in that way it's easier to calculate. And so we sell these units, we're using this only average that was provided. We sold 2,000 units. We still have 2,000 units in inventory. January 17th, we purchased 1,000 units. All right. And so since we have a purchase, we're going to calculate the average cost per unit. So we have units available in our inventory. We have 3,000 units, okay, at a cost of 17,000. So 17,000 divided by 3,000 units is $5.67 if you want to round it up. Then we have another purchase on the 22nd. And then once again, we got to calculate the total amount of units, the total dollar value of those units, and then take that dollar value and divide it by the amount of units to come out to an average. Now this new average, we're going to apply it to our sale of the 15th and to the remaining units in inventory. Okay, then we have another purchase on October 15th, so we're going to have to calculate total units, total dollar amount, divide that by the units to come out to the average, and that's applied to the sale on the 20th of November and the remaining units in inventory. Okay, so it's called actually moving average because the average changes every time that we have a purchase. First in, first out under periodic, again, is very easy. So all we take is we have the units that were sold, and we know that the cost that's going to be allocated to the units that were sold is going to be the oldest, right? So we have 4,000 units at $5.50, then 1,000 at $6, then 1,500 at $7, so that will be our 6,500 units that were sold. And then the earliest purchases will remain in our inventory. If we're using perpetual, is pretty much the same, right? Is pretty much the same. In fact, if you look at total cost of goods sold for the perpetual inventory system and their ending inventory is the same as periodic. Okay, so whatever, if you want to use, you can see that these are actually the same. There's no change there. Now, when we're talking about LIFO, for LIFO, this is not going to be the same, okay? For LIFO, the cost of goods sold and ending inventory under periodic and perpetual will be different. So again, we sold the 6,500 units. So this cost of the 6,500 units is coming from the latest purchases. So we're allocating that to the sale. And then the earliest amounts in our inventory will remain in inventory, okay? If we, and I'm sorry, kind of the boxes shifted when I uploaded the file, but if we're using the perpetual inventory system, so for every sale that we have to keep track of the different layers. It's best if you put it in order. So in that way, we know that every time we have a sale, it's gonna come out from the latest purchase will be allocated to the units that are sold, and then the oldest ones will remain in inventory. We have another cell here, so this is also going to come out from the latest one. It's right there, okay? And then the oldest layers will remain in our inventory. So cost of goods sold and ending inventory under LIFO perpetual is different from periodic, okay? All right, and then of course we should know the differences or the impact that these cost flow assumptions will have on our financial statements. So and it depends also if we have rising costs, like for example, in this example that we had, the cost of our purchases is increasing, right? It's increasing. So in that case, if it's increasing, then FIFO will result in a lower cost of goods sold than LIFO, right? Because FIFO allocates the earliest, the cheaper purchases in cost of goods sold, and then the latest, excuse me, the latest purchases, more expensive ones on the balance sheet. If we're using, if the costs were declining, so in that case, then FIFO will result in higher cost of goods sold than LIFO. All right. But once we add it all together, it should be the same. Our cost of goods sold and ending inventory, regardless of the cost flow assumption that we're using, the goods available for sale is going to be the same. Okay. It's going to be the same. All right. So in terms of disclosures, we have to actually disclose what method are we using to calculate our inventory. And most companies don't just use one method. They may use one method for one type of merchandise and another method for another. Now, in terms of these inventories, like I said, they're going to have this cost flow assumption is going to have an impact on the financial statements, and therefore that impact is going to be assessed by managers, right? And so it kind of opens the door for a bit of manipulation, if you would. There's a lot of things that are estimates that are reported on the financial statements, so we need to be careful about that. All right, now other factors that could influence the cost flow assumption. Some companies want to try to kind of assess or follow the flow of the merchandise. And so they're going to choose a method that kind of fits that flow, but they don't necessarily have to. Okay. Now, like as we noticed in here, let's go back to that. We were looking at the difference of the methods, and we said when there's rising prices, cost of goods sold will be lower under FIFO than LIFO. So if we are trying to pay less taxes, then a higher cost of goods sold will make more sense because it's going to reduce our net income and we're going to pay less taxes. If we, I don't know, get paid a bonus based on net income, then our incentive will be to have a higher net income. Therefore, FIFO will give us a lower cost of goods sold. So most companies are trying to, pay less taxes. So they may choose LIFO for that purpose. Now, what the Internal Revenue Services says that if you're going to choose LIFO for tax purposes, then you have to use LIFO for external financial reporting. All right. So what happens is that most companies consider FIFO to actually, or average cost, to actually follow the actual flow of the merchandise. Okay. And so therefore they might use FIFO for their internal records, but when they are issuing the financial statements for third-party users, they're going to use LIFO. So they're going to have two concurrent calculations of the income, the inventory, one under FIFO for internal and one under LIFO for external. Now we're going to need something to sort of reconcile these two, and we're going to use something called the LIFO reserve to reconcile it. Okay, and I think you have an assignment with the LIFO reserve. There's nothing to it. We're just, for example, here we're doing an adjustment. We have 475,000 in the LIFO reserve. And now we're increasing that to 535. So we're going to debit cost of goods sold and then credit this LIFO reserve. Okay, so we do that for external purposes to reconcile our internal and external. Okay, so this is just disclosure for using the LIFO reserve. LIFO liquidations, there's no exercises for LIFO liquidations. This is just all FYI. This part, you don't have to worry too much about it. If you are planning to take the CPA examination, maybe you want to take a look at this. But for the purposes of this class, we're not actually looking at any assignments related to this. So the LIFO liquidations is just relates to, we have so many sales of this merchandise that we're digging into the earliest layers. So even though we're using LIFO, it has like a FIFO effect, okay, on the financial statements. And so we're going to have to use some sort of methodology in trying to alleviate this distortion in the financial statements. All right. There's other types of systems that management has come out with over the years in trying to minimize inventory costs. Carrying inventory is very costly. You have to secure it. You have, especially here in Guam, because it's so hot and humid, you don't want your, items to sit too long. They're gonna, grow mold and things like that. There could be a typhoon, there could be damage, etc. One of those systems is the just-in-time system, which Harley Davidson made famous. I think even when I was in college, I kept having lectures on this, and you're gonna see this in BA 305. It's simply just like I said before, and I think more merchants, especially those large merchants, that they have a relationship with their wholesalers or manufacturers. They're trying to minimize the amount of inventory that they're keeping on hand, but they have to work out a system so that they don't run out of inventory, of course. So that's what the just-in-time system is. We have different tools to assess how management is taking care of this inventory. So this is from a user's perspective. If you're looking to invest in a company, maybe you want to take a look at their gross profit ratio over the years to make sure that they are managing their inventory costs. So the higher the ratio, the higher the markup on cost, right? So we want to have a wide gap between the sales price and the cost, because we have to use whatever is remaining to kind of pay for everything else, selling expenses, advertising, and any overhead costs that we may have, etc. So we can take this gross profit ratio and see how they managing the inventory cost. The next one is the inventory turnover ratio, basically telling us how many times has management had gone through that inventory cycle of, have cash, purchasing the inventory, selling it to a customer, getting the cash again, purchasing the inventory, selling it to the customer, and so on and so forth. We have that inventory cycle going. How many times do we do that in the year? Okay, so the inventory turnover ratio will tell us that. The higher the ratio, the more efficient the company is in managing its inventory. Okay, but it depends on the industry. Maybe we are selling, I don't know, oil pipes. Okay, so there's not going to be that much of that. So our inventory turnover ratio will be different than, I don't know, selling groceries, for example. Okay, so it depends on the industry as well. Okay, this is also FYI. We're talking about index prices. Okay, especially during inflationary periods. We have to use something to kind of smooth out these differences. We don't want, a big jump on prices that are related to inflation. So we kind of use these methods like inventory pools and dollar value LIFO to kind of smooth out these differences. Okay. So that's just FYI. I don't think you have any exercises with this. You're welcome to read this on your own. And that pretty much concludes chapter 8. Does anybody have chapter 9 from the Connect assignment that I thought it would be best if we kind of go over these together? They might be a little bit confusing. So the first one, we're dealing with what exactly are we going to report as part of our inventory. And then we're talking about FOB destination and FOB shipping point. So if we remember, FOB destination means that the buyer is not going to record that as inventory until they receive the merchandise. So FOB destination, the seller is the one responsible and carrying that merchandise on their balance sheet until it reaches the buyer's premises, warehouse, whatever they were supposed to deliver. And FOB shipping point, it means that as soon as it leaves the seller's warehouse, the title would transfer to the carrier and therefore to the buyer. So that's the buyer's inventory that's in transit. So keeping that in mind as we go over the different questions that we have here. So we're trying to determine the proper amount of our ending inventory. So ending inventory as of December 31st, 2021 was 225,000. And then before considering any of the transactions, so before any of these adjustments. So on number one, goods were shipped to Quark FOB destination. So Quark seems to be the buyer. So FOB destination means that the title won't transfer until they get it, and they have not received it until January 4th, 2022. So that means that the 42,000 should not be included in their inventory. So I guess this is correct. So this is okay that it was not included. In terms of number two, we have that the goods were shipped to quote FOB shipping point. So that means as soon as it left the seller, title transferred to the buyer. Buyer meaning Quoke. Quoke is the buyer. So that means that this 29,000 was not included in their inventory, and therefore it should be added. Okay, so I'm just going to put add. In terms of number three, we have that goods shipped from. Okay, so now Quoke is the seller, and Quoke is shipping this FOB destination on December 27th. The buyer did not receive it until January 3rd. In this case, since we are the seller, as soon as it leaves the warehouse, title transfers to the customer. So this 34,000 of merchandise, this was FOB destination. That means that we still own it at the end of the year until the customer receives it on January 3rd. So that means that we need to add this 34,000 to our inventory. For number four, goods shipped from Quoke to the customer FOB destination. Where am I reading this right? Yeah, FOB destination. So that means as soon as they leave the warehouse. Am I reading this right? Why am I getting confused? So Quoke is the seller, right? FOB destination. Oh, I see. Actually the customer received it on December 30th, and that's why we didn't. It's properly not included in their inventory. And then number five, it was FOB shipping point. So that means as soon as it leaves the warehouse, it transfers title. So therefore, Quote no longer own this inventory. So the only inventory that we need to fix is number two and number three. So these should be added to the 225. So 29,000 and then 34,000. Oops. So the correct amount of ending inventory as of December 31st is 288,000. Are there any questions regarding this inventory, when to add it to inventory and when not? So we have to make sure who's the buyer, who's the seller, and if it's FOB destination or FOB shipping point.
I have a question.
Yes.
For number four, can you just explain that again a little bit? Because in my understanding, it's received on December 30, even though it's FOB destination.
What's that? I can barely hear you.
Oh, sorry. So for number four, it says it's received on December 30. Why is it not added?
Yeah. No, because Quoke is the seller. Quoke is the seller. So the merchandise was shipped from Quoke to the customer. And then the customer received it on December 30th. So since it was FOB destination and the customer received it before the year end, we do not have to add this inventory. It was properly excluded from inventory. Because the title transferred from quote to the customer on December 30th. So on December 30th, quote no longer own the inventory. Okay, all right. Any other questions? Okay, so moving along. The next one is the discount, and we were introduced to two methods, the gross method and the net method. So here this example deals with the gross method, and we also have a sales discount and a trade discount. So I kind of wanted to briefly explain the difference between the two. The trade discount is, for example, you buy a box of, I don't know, King Card iced tea from me. Okay, so I'm a wholesaler and you buy one box. Okay, so no discount there. And then you come back and you say, okay, I want to buy 20 boxes. And I say, okay, if you buy 20 boxes, you get 5% discount. If you buy 50 boxes, you get, I don't know, 20% discount, and so on and so forth. So it's just to kind of encourage purchasing large quantities of a product. Then we may give this customer a trade discount. So a trade discount, in that respect, we're going to record the purchase net of the trade discount. So we were given, or Thomas was given, a 30% trade discount. So the original price or cost was 80,000, 250 units time at $320 each unit is 80,000. And then the 30% net of the 30% is the 56,000 net of the trade discount. So this is not related to the sales discount. That's different. Trade discount and sales discount is two different things. So I just want to make sure that you guys note that difference. So number one, we have to prepare the journal entry using the gross method for the purchase. So of course we're going to debit our merchandise inventory, or just inventory actually. And then we're going to credit accounts payable. Okay. So the inventory again is net of the trade discount. Okay, net of the trade discount. And then since we met the terms, I don't know if you can see, the terms were actually 3, 10, net 30. So 3% if it's paid within 10 days. And so we met the 10 days discount stipulations. So we are going to pay less than the 56,000 because we met the discount terms. So the cash that's going to be disbursed is going to be 97 of the original purchase. Oops, what did I do? 97.97. There we go. And then the difference is going to go to inventory because we're using a perpetual inventory system. So that will be this difference. Okay. And then if we didn't meet the terms, the 10-day payment, if we paid it on December 15th instead of the 26th of November, then we are not going to have the discount. And so we're going to credit cash for the same amount, which is 56. Okay. So that will answer 2. Now, what if instead of using the gross method, we were using the net method? And so with the net method, let me just copy these here. And copy this here. These are important. All right, and so we're going to have an inventory, a note payable, an accounts payable, but we're assuming that we're taking advantage of the discount. And so it's just going to be the discounted amount that we are debiting and crediting. And so if we meet the terms, then we don't need to credit to inventory. We simply debit accounts payable and credit cash for the discounted amount. If we don't meet the terms, then we're going to have a payable for the $54,000. The amount of cash that we paid is actually $56,000. So we're going to have purchase discount lost account here because we didn't take advantage of that. So this purchase discount lost will be added to cost of goods sold. So this reflects the amount that we did not take advantage of by paying the amount due within the terms. So most companies prefer to use the gross method rather than the net method, because with the net method it shows that they have been inefficient in managing their accounts payable. Any questions about the gross method or the net method?
No.
Okay, thanks for the feedback. Okay, the LIFO reserve. Okay, I kind of suspect that you guys, I just wanted to kind of walk you through the LIFO reserve. I think the video did a pretty good job, but just to make sure. So basically, we need to calculate the inventory based on FIFO and then LIFO, and then assess the difference. So basically, what the LIFO reserve is used for. So let's say that, or we said that for, if we want to, if our bonuses are based on the net income of the company, we definitely want to show a higher net income, okay, as managers. And so if we want to show higher net income, then our cost flow assumption more than likely will be a FIFO. Okay, that could be an objective of reporting on FIFO, or maybe it could be that it actually meets the actual flow of the goods. Either way, FIFO yields a higher net income when we have prices that are rising, like is in this case. Okay, if costs are rising of merchandise, then FIFO is gonna give us a higher net income. If we use LIFO is gonna give us a lesser amount, a lower net income, but in the same respect, it's advantageous because we pay less taxes. Okay, so our taxable income will be lower, we'll be paying less taxes. Now, since companies prefer to use FIFO, but they want to use LIFO for tax purposes, what the tax code says is that companies also have to use, if you select to use LIFO for tax purposes, you have to use LIFO for external financial purposes. So it's like the companies are going to have two sets of books, okay? In one, they're going to report with FIFO internally, but externally, they're going to use LIFO. And so in order to reconcile this FIFO and LIFO differences between these two sets of books, the internal and the external, they were going to have to rely on this LIFO reserve. That's what the LIFO reserve is used for. So in this case, okay, so we're going to go ahead and calculate our inventory, ending inventory, and cost of goods sold using perpetual FIFO. So first in, first out. We have that we sold 50,000 units on April 30th. Also, so first in, first out. Our 50,000 are going to come out from the most recent purchases first. Okay. And then in September, we have another sale. So we sold 80,000 units. Okay, so this is gone already. Okay, so maybe you should say this minus this. We don't have anymore. And then this minus this. We still have 60,000 in there. And we sold, I said 50,000. No, I'm sorry, I said 80,000. So the other 20 has to come from the July 22nd purchase. Okay, so that leaves with 90,000 units in ending inventory, which comes from the latest purchases. And that we have an ending inventory of 1,343,000, cost of goods sold of 1,869,000. Any questions about FIFO, the FIFO calculation that I just did? Are we still awake?
No, no question for me.
Huh?
Oh, no questions for me.
Okay, thanks. All right. And so moving on to LIFO. Okay, moving on to LIFO. So we had initially 50,000. So last in, first out. So the 50,000 was on April. Oh, okay. And LIFO is periodic, right? LIFO is periodic and FIFO was perpetual. So for periodic, we don't really have to know when it was sold. All we need to know is how many were sold, how many units. And so 50,000 plus 80,000 units is 130. Last in, first out. So that means it's going to come from the latest purchases first. So 60, that will be 110, and then another 20 here. So 130,000 is what we sold. And what we're left in our inventory will be 90,000 units. Okay, so 90,000 here, 90,000 here, except that our cost of goods sold and our ending inventory differs, right? Because we're using different methods. So once we're done with this calculation, then we can assess the difference between our ending inventory calculated under FIFO and our ending inventory calculator under LIFO. Okay, and so in this case, we have is 71,000 to add to the LIFO reserve. And we were told that it had a beginning balance of 20,000. So in order to increase or to match our LIFO reserve to the 71,000, we're gonna have to add 51,000. So we debit cost of goods sold and we credit our LIFO reserve for 51,000. So 51,000 goes here, and that will be our ending balance. Any questions about the LIFO reserve?
Oh,
So in other words, I'm sorry, I was just going to add, the LIFO reserve is sort of a contra asset account that's going to decrease our FIFO to match our LIFO, but it's just telling us this is the difference between the two methods.
Okay. When I was doing the homework, one of the things that kind of confused me on LIFO, and I guess I want to clarify, is that it would show that they showed when certain units were bought and sold, and so I just want to know, like, even if like a sales date is after the purchase date of the units, we still just use the most recently purchased units as the ones that get taken out of our stock.
Yes, when it's LIFO, yes.
Okay, because when I was doing the homework, I was just using the most recent ones that were in the stock, but not purchased it because at the time of sale, that recent stock wouldn't have been on hand, but I was getting that wrong. So I just want to know is why exactly would we use units that were not on hand directly? So like say this we purchased new units on the 10th, but we had a sale on the 8th. So we would have to, so we first take out from the units purchased on the 10th rather than the units that were on hand before that.
No, no. So you're saying that your sale was afterwards?
Our sale was,
Are you talking about this example when it's periodic?
yeah, because I think in the homework it was periodic in the sense that it asked to do a periodic system, but also that we purchase units after a sale, but then when I was reviewing the explanation, it still had it where you needed to take out the units. You just had to take out the last units purchased no matter what, even if you technically wouldn't have taken them out because you didn't, even though you didn't necessarily have them at the time of sale.
Yeah,
I just wanted,
for example, here we had a sale on the 9th, right?
yeah.
And we're taking units from November 17th. That's because we're waiting until the end of the year to do this. Under
Oh,
periodic,
okay.
we don't do it continuously. We simply wait. It's like, it's January 1st. You go back to your ledgers and you look at it and then you start calculating your ending inventory and your cost of goods sold.
Okay.
That's why. So here we waited until the end of the year. We went back and said, okay, how many units did we sell? 130,000. The chronological order does not matter under periodic,
Okay. Okay.
but it does matter under perpetual.
Okay. Okay. That was the one thing that was just confusing me on that. Thank you, Dr.
Yeah,
Lee.
maybe that's why I wanted to cover, because we didn't really go into the periodic, but I wanted to make sure
Thank you.
that you guys understand. Okay. So any other questions before I move on to chapter 9?
I don't have a question.
Okay, thanks. All right, so moving on to chapter 9. So for chapter 9, I kind of, like cut it off, pretty much all of it, and just concentrate on the inventory valuation. So basically, after you do your cost flow assumption and whatever, how you're calculating cost of goods sold and ending inventory, you're gonna look back at your ending inventory and assess that to make sure that the value of the inventory remains the same. It hasn't changed, because remember, we were looking at chapter 2. We were looking at the accounting assumptions and principles of the financial statements. We mentioned conservatism. Basically, we don't want to overstate our balance sheet. Okay, so we're being conservative. So we're looking at, in this case, or in this exercise, product per product. But it could be done for the whole entire inventory, or just different areas, or different departments that you have, depending on how you want to structure it. In this case, it's per product. So there's basically two methods to assess the value. One is net realizable value, and the other one is lower of cost or market. Under GAAP, we have always used lower of cost or market. But because of IFRS convergence with GAAP, we have now this net realizable value. So net realizable value is actually IFRS, but it has been combined with GAAP. So now we ended up with two methods. Okay, and I think your book does it pretty good, has a pretty good table on when each method is applicable depending on the cost flow assumption. So the net realizable value is kind of straightforward. We're basically looking at the cost, okay, the purchase cost of this inventory, and we're comparing it to the net realizable value. And whichever is lower is gonna constitute our inventory value. So in this case, cost, total net realizable value. So in this case, our net realizable value is lower. Cost or net realizable value in this case is cost. Here, cost or NRV, we have NRV. And then the last one, cost or NRV, and we have cost. So we ended up with an inventory balance of 282,000 instead of 315. Okay, so we're gonna need an adjusting entry because right now your balance sheet is showing 315. So we're gonna write down the inventory to 282. Now this, it seems very simplified in this exercise, but it's actually very complex calculation because under GAAP, once you write it down, we cannot put it back up. So if we realize that, oh, gee, the net realizable value for 101, product 101 was actually, I don't know, 120, and we wrote it down too much. Once the books are closed and you have already reported, then we cannot just say, oh, let's just put it back. We can't. Once it's written down, that's pretty much it. So if the write down of inventory is something that does not occur very often, maybe this was the result of, I don't know, some natural disaster, then we are going to debit loss, okay, instead of cost of goods sold. But in this case, let's assume it just happens, frequently, and so we are going to, oops, wrong sign. We are going to debit cost of goods sold and credit our inventory for the difference between our cost and the net realizable value. Okay. Any questions about NRV? Feedback?
No questions.
No questions? No, Beato?
Actually, no questions on that.
Okay. All right, moving on to lower of cost or market. Okay, for lower of cost or market, it's a little bit more complex, okay? First of all, we need to figure out the ceiling and the floor. Okay, so it's kind of like we're building these parameters, and if it goes too high, we are limited by the ceiling. If it goes too low, we are limited by the floor. Yes.
I'm not entirely sure if it's just on my end. Oh, I think, okay, never mind, I think it's on my end. Sorry, it's just I can't see my screen's still stuck on FIFO, the Excel sheet.
Okay, does that help? I made it like the full screen now.
I think it might just be on my end because actually I just saw Noli said he can see it.
If it doesn't work, maybe get out and come back in if you're, frozen.
Okay, I'll try that.
Try that. I'll wait for you like 1 minute. Any other questions regarding the topics that we looked at while we're waiting for Beato? Anyways, the session is being recorded. So if you guys have any questions, you can always, go back and review it. Okay, I think Beato is back. So continue
Okay.
on. Huh?
Oh no, I was saying I can see it now.
Okay, all right. So like I said, we have a ceiling and a floor for under lower of cost or market, okay? And the way we do the ceiling is just the net realizable value, all right? The net realizable value is our ceiling. And I believe that was given to you, the net realizable value. And then the floor is gonna be a net realizable value less the normal profit percentage. In this case, normal profit was given as 25% right here on this one here. And so I just took 25% of the cost and then subtracted the net realizable value from that to arrive at these numbers that are shown here under floor. Okay. And so we're going to go and check each account, each number again, each product. We have the cost versus the replacement cost. Now, in this case, our replacement cost is, now, when they say replacement cost, what they mean is if I purchased an item for $131,000 and if I was going to purchase it again, I don't know how much the time passed between my first purchase, but if I were to purchase it again, now it will cost $119,900. So that's the replacement cost. So the replacement cost is $119,900. And so I'm looking at my parameters and I observe that 119 exceeds the ceiling. So the market is limited to the 108. And this is also going to be my inventory. Okay. All right. The next one, 102. I'm looking at the cost. I'm looking at the replacement cost. So replacement cost is lower. Replacement cost is lower than the floor. So that means that I can only report, the lowest amount that I can report is up to the floor. Okay. Again, product 103, I have the cost and the replacement cost. The replacement cost is lower and it falls within the limits. So I report the full amount of the replacement cost. Now, for the second one, for the last one, 104, okay, we observe that the replacement cost is lower than cost. Okay, and the replacement cost is up to is lower than the ceiling, so I can only go up to the ceiling. But the ceiling, I'm sorry, not ceiling, the floor is higher than the cost. So the lowest amount that I can go is the cost. Okay, so I'm going to highlight that. So once again, replacement cost was lower than the original cost. Replacement cost is lower than the floor, so I'm limited to the floor. But because the floor is higher than cost, then the lowest amount I can report is the cost. You have to think about this way. I can never write up cost. I can write down cost, but I cannot write up the cost. Does that make sense? Sort of. Okay. So once that we have this difference between the cost that we have per our books and the inventory valuation, then now we get to do our adjusting entry, right? Let me just extend this. Debit cost to be sold and credit inventory for that difference. Any questions? We're still okay? Okay. I just wanted to let you know that I updated, I think, Connect. In Connect, I have extra credit for you guys. Just get this up. There's an extra credit assignment for SmartBook. I also posted some information on your final exam project and the final stage of the project, which I still owe you the first part. So I'm aware of that, and I'll try to give you that this week. There's also a practice exam, I believe, in Connect. So you might want to take a look at that. And let's see, the practice exam is due on the 27th. What am I looking at? Yeah. Practice exam is due on the 27th. And then we have the exam on the 3rd. So the exam will open on the 3rd, but it's not due until the 29th. So on the 27th, next Monday, what we do is we'll cover the practice exam questions that you may have questions on. Actually, no, I'm doing that on the 22nd. So on the 22nd, we'll have a live session again, meaning this Wednesday, to go over the practice exam questions, but the practice exam is actually not due until the 27th. Does that make sense? So I kind of want to go over some of the practice exam questions that you may have difficulty with, and I kind of address that on Wednesday so that you can submit the practice exam on Monday. Any questions?
Yeah, I should got it.
For the extra credit?
Is that gonna just go to our participation or the project or the exam? Well, which one?
The participation.
Okay, thank you.
Any others?
Wait, so I just want to clarify. So the practice exam is open now, but not due until the 3rd?
The practice exam is open now, but it's not due until Monday.
Oh, Monday, okay.
Yeah, so that's why I kind of want to go over on Wednesday, this Wednesday, with you guys, some of the questions that I think it might be difficult for you guys, and then in that way you can complete it by Monday.
Okay. So we're gonna have
Yeah.
another big button session.
Right, exactly. Yeah. Okay, so if no questions, let me just stop recording because otherwise